Good afternoon. My name is Alan Nochumson, and I'm with Bryan and Ryan of IFundPhilly. Welcome, guys.
Thanks, Alan. Hey, guys.
So I thought this would be an interactive and good discussion about financing real estate projects, both ones that are already existing apartment buildings or single family, as well as talking about the avenues one may have during construction. So Ryan and Bryan, prepared a PowerPoint presentation, which we can go over. But guys, why don't you first introduce yourselves?
Sure. So I'm Ryan Herting. I'm one of the founders of IFP. Background in building residential and multifamily projects in Philadelphia. And also have spent a lot of time building sales teams. I kind of run the biz dev section of IFP with our other partner, Chris Terrio.
Hey everybody, this is Bryan, IFundPhilly, joined in 2018 as one of the co-founders and really run kind of the back end kind of part of the business for the group, focusing on more the capital markets, our institutional relationships, our banking relationships and the like. Thanks for putting this together, Alan.
Oh, you're welcome. You're welcome. I know a lot of my clients use you guys in terms of financing their projects. And I thought it would be good to kind of understand from people who have their boots on the ground. So why don't we start off? So in terms of, if I'm an owner of a property and my loan is about to go to term, and I'm with a hard money lender, what do we have to do to get a loan with you guys?
Yeah. So why don't I kind of frame this as a, what the market, where we've gotten to where we've gotten to as far as what we're seeing. So I've done this presentation a handful of times where I describe where the institutional part, which is the Wall Streets, the private equity companies, how they've come in to this specific market, kind of fitting in themselves between a hard money lender and a bank. Okay. And over the last 2 weeks, we saw basically at the institutional level, what took place in 2008 took a year and a half. A year plus took 2 weeks. The market, as for a whole multitude of reasons, some of the larger banks, did some actions, and that whole kind of ripple effect has impacted everything from lending, your traditional Fannie, Freddie, Ginnie, jumbo, your bank loans, and then all the way down into our space, which is fix and flip, construction loans. And so the market essentially froze up. In about 2 weeks, you took a massive amount of liquidity out of the market. As folks were not buyers, they became sellers of certain loans, and the liquidity, for the most part, kind of froze up. And we've been, we have a pretty diverse balance sheet. We were leveraging some of those our institutional relationships to originate loans. We have loans that are on our balance sheet. So depending upon your capital structure, folks have stopped lending. Folks have, are just taking a wait and see. There's just a macro concern across, I think, anybody that owns real estate of what does the coronavirus and the impact of shutting down an economy on a regional basis, on a national basis, on an international basis, what that does to unemployment, which drives, it drives people collecting rent checks, it drives people collecting or selling houses. And so there's, across everybody's kind of a wait and see attitude of where, what some of the impacts might be.
What about current loans? I hear that people who have loan commitments now, they're still able to close, although I've heard that some of the lenders have tried to change some of those terms, even with a loan commitment signed.
Yeah, I mean, you know, we've definitely seen where people, if they didn't close a loan, the bank, you know, depending upon which institution they were at, said no. Even if they had commitment out there we've heard they said no. We've got, you know, deals that are definitely continuing to move forward. It kind of depends on the counterparty.
Mm-hmm.
The main, like some of the things, it's depending upon how the loan was viewed. Like if income was a component and now there's uncertainty about somebody's future income, it's very difficult to say, yeah, we're going to go close that loan until there's more certainty around the income of the future income. So it's really going to depend on a case by case basis. You know, one of your question around, you know, you're trying to refinance out of a you know, construction loan. So depending upon the size and where you're, you know, so, you know, we have not heard of any of your small regional banks that refinance a lot of our loans out. We haven't heard of any reactions at this point. I think it's probably difficult to get appraisals and to actually close the loans, but we haven't heard of any tightening of guidelines at that segment of the business or that segment. I would anticipate some tightening from community banks in the near future. And then at the, you know, a lot of lenders like us had rental loans, 1 to 4 family rental loans out in the market. So if you had single family kind of SFR or single family rentals, 1 to 4 units, there was, you know, most lenders in our space had that type of product. Mm-hmm. And that's completely gone away. There's not, I don't know of any lenders that are actually still able to do that product. I think, and so there are some, you know, we have the ability to put people into 2-year bridge loan. Mm-hmm. As the market comes back, stabilizes. So we've been offering that to our customers as a short-term option of getting out of a hard money loan where they, you know, they might have to incur some, you know, higher interest rates if they've reached their term limits, and have to get out, you know, they just might be paying a higher rate. And so we've got, you know, a little bit uniqueness there. It's not as competitive as a bank interest rate, but it's not too far off. And so that's been helping people out there. I mean, on a more of a macro sense, I think we see this as a liquidity, you know, we see this as just a liquidity concern where, you know, it's a convoluted web of how the financial systems kind of are a lot tied together. But as things have stabilized, the Fed is out buying mortgage-backed securities, positive for a whole bunch of credit space. As those things impact and tighten up the credit spread, and there isn't as much fear in the market, will happen at some point. I don't know when, but as those things come in over time, you know, we're super bullish as, you know, real estate investors ourselves, supporting the real estate community, real estate investment community. There's a lot of value there, and we also think there's a, you know, super positive, at least I think, you know, a super positive kind of dynamic that might come out of this for kind of the long-term economic picture of the U.S. So, you know, we think there's a lot of positive things, especially around some of the core things that ground Philadelphia and a lot of your customers, our customers, eds, meds. So when we think about, you know, some of that fear, it could be some things that are more regionally based, and we think, you know, there's a lot of reasons why certain areas in Philadelphia are going to weather this pretty well.
All right. Well, I know you guys did prepare some type of presentation. Maybe we can ask questions while we go through that presentation.
Yeah, so Bryan touched on a bunch of it, but I think what we'll do here is Bryan, just want to give a review of kind of what you said. I mean, Bryan touched on a lot of this, guys. Mostly that we feel this is a liquidity issue in the marketplace at an institutional level. You know, so Bryan, maybe expand on how the institutions and what happened with warehouse capital, repo banks, et cetera, just to give them a perspective of why it's slowed down.
Yeah, I mean it's the easiest way to, I'll just summarize it really quick and I'll give a quick example. So we mentioned the word non-qualified mortgage in here, and so essentially what two kind of events happen. With the unknown unemployment, a large purchaser of securitizations, a large money manager, they were one of the first to stop purchasing securitized assets, securitized loans, which are either the non-QM loans, rental loans, whatever, these types of securitized assets. They said, we don't know what the risks are. They stopped buying. A large bank in New York, woke up and said, I'm not going to provide warehouse fit, the leverage that a lot of aggregators take on of pledging loans. And then you get, they're pledged into warehouse facilities. They said, I don't like the risk associated with these certain products, non-QM, fix and flip loans, rental loans, those types of loans. And so, in order to raise capital and meet those, there was a lot of margin calls. There was a lot of fear and deleveraging, which is, the liquidity that had to come out of the system. And so that's, in essence, what, largely what happened here, over essentially about a 2-week period.
Any questions on that, guys, before we move to?
Let me see if we do have any questions. Let me go look at Facebook here and see if we have any questions. So I don't know if you guys are on our page as well. So let's see. Let me just take a look to see if we have any questions. Right now, we do not have any questions. So when we go to next, how lenders are thinking.
Yeah, so Bryan mentioned the reasons the banks had started to pull back and decrease leverage, and here's how they're thinking about potential pitfalls, incomplete projects, properties not secured, potential declines in market values, contractor delays. We obviously know what's going on in Philadelphia, and Alan, you can maybe spend some couple minutes talking about what that looks like with waivers at the state and local level. And then cash flow issues. Bryan mentioned the unemployment, rental rate decreases, default servicing costs. So these are all of how a lender thinks about potential risk in different potential projects amongst multiple asset classes, and why you've seen rates increase and leverage decrease over the last 2 weeks, and lenders altogether stop lending.
So what are you seeing in terms, obviously, with the construction projects, with construction to standstill? There's no draws being taken, right? Are there discussions about, if the construction loan period is about to expire, about extensions of time? What are you hearing in terms of that environment?
Yeah, so we could spend a couple of minutes talking about how we're thinking about it, and then maybe what we've heard in the marketplace from other lenders that we're talking to would be, I think, helpful for these guys.
Yep. So we're already seeing the extension requests come in on our book, and I think the market just generally believes that it's just going to take longer, for Philly to get back online, for other municipalities to get back online, and you're going to have a natural backlog. And so I think, a lot of lenders we've spoken to, acknowledge that. Some have done, depending upon where the project's at in the process. Some have already done some forbearance type of activities that push out the term a month or two. It's really going to be project specific. A couple key things that I always tell our customers, and I tell anybody, is make sure you're current on your loans. Don't give them a reason to not either fund your draws or not give you the extension. Most people understand that folks, including ourselves, we don't want half completed projects. We want, the whole reason we did this is to see it through. And a completed project's worth a lot more to everybody than half completed projects. So that's, I would say communicating is going to be key with your lenders. as you're working through the project. Over communicating is going to be better than not communicating.
I'm looking at your chart here in terms of new acquisitions. It looks like, before you would be able to put less down, and it looks like now, I guess it's implied that you're going to have to put a lot more down so the banks feel secure with the transaction, right?
Yes.
Yeah. I mean, I think you're going to see across the industry is a more kind of, a deleveraging of a lot of deals. Like, people were putting about 10% down, kind of pre-virus. I expect that number now to be closer to 30 or 40%. And so, again, the key for all the your customers that are listening in here is, we believe this should, for good reasons, there's going to be more cash, but you should take this into consideration when you're bidding on new projects, and you're, in order to make money, you're gonna have to buy things at a lower price point. We think this is largely kind of industry standard of what you're going to see. We've seen this across many we've seen this kind of consistently. Is you had interest rates kind of in the 8 and 10 range, 10 and 9 and 2, 10 and 2 range, for a lot of customers, kind of pre-virus. I mean, that's those rates are kind of more 12 and 3, 12 and 4 range. Gotcha.
If, so in this environment, you were saying how, prices are going to go down on these properties. Like, someone finds a good deal, like how likely is it they're going to be able to close, and how quickly would they be able to close?
Yeah. I mean, so we're working. We think, depending upon, as far as the timelines with appraisal companies and the like, we're still, anticipating kind of a 3 to 4 week close period. We had done things faster prior to the virus, but we're telling customers 3 to 4 weeks. It has to go through kind of the normal review process. But there's just, it's just a little bit more costly. So you got to factor that into your return on investment, and you got to be buying stuff at a lower price point.
Now, are they because there's no opportunity to evict tenants in Philadelphia, and we're focused on Philadelphia specific properties. How does that work from an underwriting perspective? Like, what are the lenders asking for in terms of that? Because, they're obviously asking for rent rolls. Are they asking for anything in addition to that to feel some type of sense of security that, tenants will pay going forward?
Yeah. So what we are seeing is more. So if there's a concern about the underlying cash flows of the property, we are seeing more reserve requirements, so that the borrower, if they're not able to collect rent for months, because of the underlying tenants and the eviction process, I mean, that is, that on the macro sense, that is definitely a major concern. But we're looking at more liquidity requirements of the customers.
Gotcha. And what about home sales? I mean, do you see a lot of your clients, who are under agreement closing on properties?
I mean, we just had a customer that I think it was yesterday, the day before, sometime this week, that had went under agreement of sale, and he's got a May settlement date. So it was an empty house. I think there's all different types of reasons for that, but it's a single family home, empty house that was able to get, somebody was able to get comfortable purchasing it. So that's, has a target date of May. Let's hope we're able to have real estate transactions take place by then.
Gotcha. So what do you think about the future? Like, what is the future? Like, is the future May, June, July?
We had that answer, we'd be on a boat somewhere.
Yeah, exactly. What's your gut? Like, because Ryan and I were talking before this session, where we were talking, it's at least a few months before things open up. And then even after that, the banks are not going to feel secure for potentially until the beginning of 2021, right?
Yeah, I mean, listen, it's depending upon what day of the week it is. I kind of sway on how bad this. I mean, I think this is a pretty, this is unmodelable. So that tells me that it's going to be a long, it's going to take some getting through this process to see some of the data come through, because no one can model it, because nothing like this has happened, and we've been able to, that you can model. And so it's going to take time. I mean, it's definitely a major concern of us, what this looks like more on the unemployment side. I mean, it seems like a lot of good companies are doing what they can to soften the blow, but it eventually happens. I mean, Disney furloughed their employees. I mean, it's just things that are just have to happen at some point. And it's going to take a while if your business is centered around travel. It's going to take time. I think certain things are going to snap back faster, but it's definitely going to take time. And we're anticipating some, an opportunity to, I think for our investors, our customers, to purchase real estate at a cheaper price than they would a month ago. It's going to create opportunity. It's going to create consolidation. I mean, if you're a good operator, with cash or the ability to execute, you're going to see some consolidation. It's going to take out a lot of noise in this space.
Well, I'm sorry, Bryan.
I was going to say, so from a lending perspective, I think institutional-based lenders like ourselves and others are going to be consolidated to managing balance sheet assets only temporarily. We see Wall Street coming back, 9 to 12 months. You're going to see hard money guys with big balance sheets and private funds continuing to lend at higher interest rates. Those kind of 12 to 14 numbers, 3 to 4 points.
Gotcha. So let's spin this in the positive. If I'm in the game, or I want to be in the game, what should I do to prepare myself?
So, Kat, let me say, like, my view, cash is king right now. And so be opportunistic. I would, if you're selling places, you might not want to, I mean, I wouldn't wait for the last 5K or negotiate over the last 5K. I keep the velocity going. I think about ways you can be opportunistic in the future. I mean, I hope I'm wrong, but and things snap back a little bit faster, but continue to develop, your relationships with local banks, other lenders like us, know what's going on in the market, take it as an opportunity to be knowledgeable, and focus on, if you're operating, is how do you build the best operating part of the business, to get through kind of your projects and get on the other end.
Yeah, and the only thing I'd add is, if you're doing acquisitions, be patient, right? Like, we're just kind of in the infancy of this thing. I think there's going to be more to come. Hopefully I'm wrong as well, but if it does delay out through May, I think there's going to be more and more opportunity and steeper discounts, and unfortunately for others, and fortunate for others, for some, to acquire at deep discounts.
Yeah, well, and especially I would say the commercial building market, right?
If it comes back,
commercial building markets are probably going to take the biggest hit, right?
That's exactly right.
So, all right. Well, if anyone wants to be able to reach you guys to like talk further, see what lending opportunities there are or borrowing opportunities, how can they reach you guys?
Yeah, so you can find us on the web at IFundPhilly.com. You can also learn some more about us on Facebook on our pages, IFundPhilly. You can click there and answer some of your questions, via the link, and then Alan, I can circulate a contact page for you.
Yeah, and if you don't mind, we'll tag this maybe presentation material. We'll put it on our website as well with it, so that people can have a better understanding. And maybe if you like update it with your contact information, that would be helpful too.
We can do that.
Awesome. Well, thank you so much for your time, guys, and have a great day. It's beautiful outside.
Thanks, Alan. Appreciate the time. Thanks, guys.
You're welcome. All right, take care. Bye.